Jahangir Aziz is now with us, Head of Emerging Markets Economics Research at JPMorgan. Jahangir, good to have you with us here. Thanks very much for your time. Thanks for waiting. Quick word, Jahangir, first up. Does the 7-day extension, if you can call it that, give us time to negotiate these tariffs lower?
I'm guessing that at least there will be a lot of activity and a lot of effort being put into negotiating these lower. Whether it'll be negotiated lower or not, is anyone's guess. But I'm guessing that's the direction of travel, that the Indian and the US would try to negotiate these these tariff rates lower. 25% is pretty high, right? And let's not forget there's a penalty on top of that.
So the penalty is the unknown, right? Do you think it's a serious threat and there'll be a number instead of the unspecified penalty, or that's just sort of something, a sword left hanging, is part of the overall negotiation tactic?
Look, the way in which this administration has dealt with other matters, I think at some point in time the threat becomes a number. So I'm guessing that at some point in time, the threat becomes a number, whether it's 10, 15, 5, I have no real idea. But I'm guessing it is going to be a high enough number so that it conveys the sense of, urgency and, inflicting pain on those who do not, those who keep on buying Russian oil.
Jahangir, hi, good morning. The US itself has been absolutely resilient, right, throughout all of this. And as President Trump was saying yesterday, that there'll be, billions of dollars pouring into the United States now from, maybe not from the 1st because it's effective 7th, so maybe from the 7th of August. But what are your forecasts for inflation? Do you see any increase at all, or, will it continue to be pretty solid?
So we are looking at a spike in inflation sometime around August, September, where core inflation breaches probably 6% on an annualized basis. You can already see that in the data if you're willing to look for it and rather than just look at the headlines and go away. So if you look at goods inflation in the US, ex-autos, in the month of June, it was running at an annualized pace of 6.8%. So this idea that tariffs are not having an impact on inflation, people are just not looking because they're just looking at the headline and walking away with that. And if you look at the amount of the observed tariff rate, not the kind of tariff numbers that analysts that come around and say that it's 15% or 12%, 13%, but the actual tariff rate, the total amount of tariff divided by the total amount of imports, that's running close to 9.5% to 10% in the month of June. It was running, as you must know by now, 2% back in December, and the run rate over the last 3 months has been on average around 7.5%. So 7.5% of in tariff, which was about a 5 percentage point increase from what it was, let's say, in December, delivers you a 6.8% inflation rate on goods inflation. So inflation is being affected by tariff rate. That's the reason why the Fed chair is very wary of it. People are just not looking under the hood. They're just looking above the hood and saying, well, things not really do that bad.
So, Jahangir, isn't it surprising that a market's supposed to, price in the future? And if the future is saying 6% inflation in the US, then isn't the equity market resilience surprising?
Look, if you talk to any of the, economists, they will tell you that at the end of the day, this increase in tariffs is essentially a consumption tax. So if you look at the actual, not the observed tariff rates, but the actual amount of tariffs collected in the month of June, it's running at an annualized pace, not the month of June, but if you multiply it by 12, it's running at about $350 billion. So that's essentially the amount of taxes that consumers or corporates will have to pay. That has to either get absorbed in lower profit of 350 billion or higher or increased taxes of 350 billion, or some combination of the two. So there is a pain. There is pain already there in the system. It is just that it is not surfacing up to the headline numbers. And our sense is that give it time. Let's wait for about a month or so. It will hit the headlines.
Hi, Jahangir. Let's look inward then, because, the US piece seems to be a little bit puzzling what President Trump will do, what the Fed will do next. Let's talk about the RBI, because there is hope that there could be some monetary easing. I'm not sure whether more can be done, but what are you factoring in, and what do you expect from the RBI? Because the big meet comes up in August.
Look, I mean, there is monetary easing and there is the impact on how the market reacts to the monetary easing, but I will leave that aside. So yes, I mean, I know we don't have a rate cut anymore. We don't have a rate cut. We have things on hold. We had 100 basis points of rate cut back in September of last year, when people didn't have any rate cuts. We got the 100 basis points of rate cuts. We don't have any more left. But my guess is that if you look at the statements coming from the RBI, they have now sort of shifted away from the statement that they have in the policy meeting to saying, okay, we will be data dependent. My guess is that they'll be forced to be data dependent. And if growth slows, and if you don't get any spike in core inflation, I think the space gets opened up. Now, as I said, we don't have it in our baseline, but my hunch is that the risk is that we probably will be seeing rate cuts or more, more liquidity being pushed into the system. But I think you have to wait for it. And if you get a rate cut signal from the Fed, whenever it is, I think that would be a good opportunity or good point at which the RBI can hang its hat on that and say, okay, fine, we are going to start cutting rates a little bit more. But we don't have it in the baseline. But the risk, I think, is that you will probably see more rate cuts.
Jahangir, pleasure speaking with you. Thank you very much for joining us. Good getting that insight on a variety of subjects. Let me just